Hi everyone, welcome to the 8th video of me learning how to trade using Forex. So in the last video we covered short selling, what it is and how it's done. We're now currently on CFD trading, so yeah, let's get started. What is CFD trading? CFD trading enables you to buy and sell Forex shares, indices and more from a single account. So CFD trading allows you to buy and sell Forex shares and indices from a single account. Indices and more from a single account. What are CFDs? CFDs are a type of financial derivative that enable you to go long and short on thousands of different markets without ever taking ownership of any physical assets. So CFDs are a financial derivative that allow you to go long or short without ever taking ownership of any physical assets. CFD stands for contract for difference. CFD stands for contract for difference. Contract for difference. Instead of buying and selling the underlying assets, you speculate on its price movement. This means you can speculate on a host of different assets, from shares to indices to commodities and more, without needing to open accounts with lots of different brokers. How does CFD trading work? CFD trading works using contracts that mirror the prices of financial markets, such as share, index or currency pair. So CFD trading works using contracts which mirror the prices of financial markets. When you open a CFD trade, you agree to exchange the difference in the price from when you open your position to when you close it, hence the name contracts for difference. When you buy a CFD, you will make a profit as the market rises in price, but you will make a loss if the price falls. Okay, so when buying CFD, profit is made. When buying CFD, if market rises in price, profit is made. Otherwise, loss is made. When selling CFD, if market falls in price, profit is made. Otherwise, loss is made. When you sell a CFD, you make a profit as the market price falls, but upwards movement will lead to a loss. The number of CFDs you buy or sell dictates the size of your position. Buying a single Apple CFD, for example, is equivalent of investing in one Apple share. Buying 10,000 Apple CFDs more is the same as purchasing 10,000 Apple shares. The the number of CFD you buy or sell determines your size of your position. Wait, this to close a CFD trade in the opposite direction. Yes. So this one makes sense. When you buy one, you make a profit as the market rises in price. So for example, you buy at $1 or £1, whatever, and if the market rises in price, and you sell it for £2, that's £1 profit. But if the price falls to, well, it's not going to fall to zero, but let's say if it does fall to zero theoretically, then you then you make a loss when you sell a CFD. So, for example, if you're selling it for £5, you'll make a profit as the market price falls. So the market price drops to £2, then you can keep the £3, right? But upward movement leads to a loss. When you sell a CFD, oh, I need to get my head around this buying and selling stuff. I get the buying stuff, but selling, I need to clear my head around that. CFD trading examples: buying oil. You buy US oil CFDs at 5325 when oil is at 5324, 5325. Each CFD will earn you $1 for every point of oil that oil has moved up in price. US oil rises 30 points to that. So you sell 5 oil CFDs at that to close. Closing a CFD trade means that you exchange the difference in the asset's price from when you opened it. The market has moved 30 points in your favour, so you make 30 times 5 CFDs. However, oil has moved 30, you will have to pay $150. Buy CFD, 5 CFDs. If the oil market rises 30 points, you'll make 3 times, then you lose 15. Selling the US 500. The US is at that. You short the US by selling 5 CFDs at that. The US dollar falls to that. You close your trade by buying 5. Ah, right. So you buy it back. So you sell it for a higher price than the price you're buying it back from. So for example, you sell it for £10, but then the actual thing falls in price, so now you can buy it back for £2, and then you made £8 profit. Right. The US market has moved 65 points in your favour, so your high CFDs earn you $225. However, if the US plus 500 climbs have fallen, you would have made a loss. Benefits of CFDs. Range of markets. CFDs providers typically offer access to lots of different assets. With Forex.com, for example, you can buy and sell all of the following from just one account: 80 plus FX pairs from majors such as Euro USD to exotics, the world's leading indices including UK 100s, Apple, Barclays, Tesla, thousands more global shares, commodities such as gold, oil and silver. This makes CFDs an excellent way to diversify your exposure. If you're concerned about a global stock market slowdown, for example, you can use CFDs to trade commodities or Forex. In doing so, you won't be so dependent on stocks to generate returns. Going short. As we covered in the previous lesson, going short with a stockbroker can be a tricky process, if your broker even allows it. Opening a short position with CFD, though, is essentially just the opposite of going long. This can make CFDs popular for hedging. Some investors use CFDs to avoid having to sell an asset that they believe is in for a temporary downturn. For example, if you hold £5,000 of Vodafone shares and are concerned that they are due for an imminent sell-off, you can help protect your share portfolio by shorting £5,000 of Vodafone CFDs. If Vodafone's share price falls, the loss in your portfolio will be offset by gain in your short sell CFD trade. In this way, you can protect yourself without going through the expense and inconvenience of liquidating your stock holdings. Physical Vodafone shares. Should the share price fall, your loss is offset by the gain in your short sell position. So they cancel each other out somehow, but I don't really understand how this diagram. So this is the price you buy it at, I'm assuming. So this is a rise in price, which is good. This is fall in price, which is bad. So if you sell the £5,000 worth of the shares, then if it does fall in price, you can always buy it back with the cheaper. With the cheaper price. I think that's what it's trying to say. Leverage. CFD trading is a leveraged product. CFD trading is a leveraged product. So you only need to put down a fraction of the total value of each contract to trade. In other words, you can put up a small amount of money to control a much larger amount, which makes CFDs popular among investors who don't want to tie up lots of capital on each position. When trading a Barclays CFD, for example, you might only have to pay 20% of the value of Barclays shares. The deposit you pay is called your margin. So you put up a smaller amount into control larger of money. The deposit is called margin. It's important to note that margin will magnify profits and losses from a trade, however, so while it can lead to high returns, it will also increase your risk. CFD trade on Barclays using leverage. You buy 1,000 CFDs, total value of trade, amount required, margin at 20%, 500, profit made 100, return on investment at 20%, additional cost, overnight financing, commission charge of 0.2%. If you buy 100 Barclays shares, 100 shares, 2,000 amount to open position. If you bought profit made, return on investment, commission charge, UK stamp duty. CFD trading allows you to speculate on price movement without actually owning them. Because of this, you'd have to pay the UK stamp duty on CFD trades, which would be required if you're investing in assets themselves. Remember though that UK tax laws are subject to change and depend on individual circumstances. Is CFD trading right for me? CFDs are ideal for people who are looking to either invest, speculate or hedge using leverage. However, they contain significant risk to your money and are not suited for everyone. CFD trading may be ideal for people who are looking for short-term opportunities. CFDs can be held open for a few days or weeks as well as over the long term. Who want to make their own decisions on what to invest in. Most CFD providers offer an execution-only service. Looking to diversify the portfolio, Forex.com offers access to hundreds of global markets including shares, commodities, FX and indices. You sell 15 gold CFDs at that 1949 and you close position at that. What's your profit or loss in USD? You sell 15 gold at that. And close your position at that. So what's 2023 minus 1949? 51 plus 23, 74 times 15, 74 times 15. Yep, that's not right, that's what I was saying. 74 times 15. Wait a second. Times 50. 1110. Profit. What's this, a loss? Oh, because you're selling, you're not buying. Oh, right, I read that wrong. If you buy, then then it's a profit. But this is a loss because you sold it at that, and now you have to buy it back at a higher price, so you lose your money. What would your profit or loss be if you bought 10 CFDs at that instead? If you bought, hold on, it'll be, oh wait, let me do that again. If you bought 10 CFDs at that 2020, then sold them at that, so that's still 74 profit. Cool. How to open a CFD position. Before you start trading CFDs, you should test out buying and selling using a demo account. Here are 5 steps you can follow to open your first CFD position. Number 1, choose a market. There are lots of tools on hand to help you find a trade that suits your style. It's worth taking a look at some of the latest financial news analysis to catch up on what's happening in the markets. Popular assets among beginner traders include the major FX pairs, headline indices and blue chip stocks. Decide what you want to trade and search for it in your demo. Decide whether to go long or short, so whether it's going to increase in price or whether it's going to decrease in price. Now it's time to decide whether your chosen market is in for a bull or bear move. Different traders make decisions based on different data. Fundamental analysts, for instance, will look at the facts and figures, while technical traders only look at price charts. You'll see both a buy and sell price listed on your platform. Choose to buy if you think your asset's headed up, or sell if you believe it's a negative move. Click on your market to bring up his ticket and then select buy or sell. Select your trade size. The number of CFDs you buy or sell will indicate the value of your trade, as well as how much you make or lose for every point of movement in the underlying market. The value of an individual CFD varies depending on the instrument you're trading. In stocks, for example, a CFD is equivalent to buying or selling a single share. In Forex, it's the same as a single lot. Your CFD may also be valued in different currencies for different assets. Remember, CFDs are leveraged, so you won't have to put up the full value of your trade up front. Commission or the spread. You'll pay to open a CFD position in different ways depending on which market you are trading. If you're buying or selling a share CFD, then you usually pay commission, just like investing in shares with a broker. Most other markets have these costs included in the spreads. Choose a quantity of CFDs to trade. Check the margin calculator in the market to see how much of your virtual fund you need, then open the position. Add stops and take profits. Stops and take profits, also known as limits, are orders of to automatically close your trade once it reaches a certain level. They're an important part of managing risk. Add a stop to tell your provider to close your position if it hits a specified level loss. Take profits on the other hand will close your trade once it's moved to a certain amount in your favour. We'll cover stops and take profits in more detail in the guide to order set lesson. Decide a profit target and the maximum loss from your trade and add a stop and take profit accordingly. Monitor and close your position. When your trade is open, you'll be able to see any overrunning profits or losses on the open position tab on off your platform. As the underlying market moves up and down, you'll see its price movements reflected in the value of your position. You'll close your trade by dealing in the opposite direction to where you opened. If you sold 15 CFDs at the outset, now you'll need to buy 15 CFDs to net off your exposure. Alternatively, if the market's price hits your stop or take profit, then your position will be closed automatically. Take a look at your open trade in the Open Positions tab on the platform. Trade in the opposite direction to how you opened your position to close it, or just hit close. Introduction to leverage. One of the main features of CFD and Forex trading is the ability to utilize leverage. But before you get started, it's worth learning exactly how leverage and margin work. What is leverage? Leverage is a tool used by traders that enables you to control a large amount of capital while putting down a much smaller amount. Unlike traditional investing where you must pay for the full value of your position up front, with leverage trading you only have to pay a deposit known as your margin. In the case of 50 to 1 leverage, for example, you can use £51 to control a position worth £50. So, 1 leverage is using £1 to control £50. Control a position to control. Leverage has opened markets such as Forex and commodities to more retail traders who don't want to allocate large amounts of capital to each position. However, it will magnify the profits and losses from any trade, so it should be used with caution. What is margin? Margin is a capital that you will have to put down to open a leveraged trade. Different markets will have different margin requirements. You might have to pay 20% of the full value of the shares positions, for example, while you could only have to put down 5 on X with Forex. CFD trading is a popular way of accessing leverage when buying and selling shares, indices, Forex and more. Let's examine how it works in practice. Leverage example, share trading versus CFDs. Share investing. You buy 1,000 shares in company XYZ with a share price of 250p. The value of your trade is £250. You're buying shares outright, so you have to pay full amount up front. Profit. If the company's XYZ share price rises to 260p, then you can sell your shares for 2,600, earning you £100 profit. You made £100 from £250, 2,500, a return of 4%. But what if XYZ share price fell to 240p? You'll lose £100 or a 4% loss. Share CFDs. You buy 1,000 shares with the same CFDs in company XYZ has a margin requirement of 20%, so you only have to pay £500 to open. Profit. If company XYZ share price rises to 260p, then you can sell your CFDs to realise a £100 margin. You made £100 from £500, a profit of 20%. You still lose £100 on the CFD trade, but because you only put down 500, that equates to a 20% loss. As you can see in the above example, margin will multiply both your profit and your losses. Because of this, using orders as a part of a comprehensive risk management plan is crucial when using leverage. We'll cover this in more detail in the strategies and risk course. Margin calls. You will always need to ensure that you have enough margin in your account to cover the cost of your open trades. If you don't, then you could quickly find yourself on a margin call, which means your position will be at the risk of being closed out. Position due to not having enough margin in your account to cover the cost of your open. If you drop below 50% of your margin requirement, your position will be closed automatically. Returning to our example, say that company XYZ share price drops to 220p. Your running losses from the trade would be 300, which would mean that you have less than half of the £500 required to maintain your position. At this point, you'd be at the risk of seeing it getting automatically closed. This is to prevent your losses from becoming too large. If you get placed onto a margin call, we'll let you know via email. At this point, you have three options: close out your position, reduce the size of your trade to free up some equity in your account, add additional funds to your account to cover the shortfall in margin, plus additional funds to sustain any further losses. If you leave your position and it drops to 50% of margin, we'll close it automatically. Leverage costs. As with standard investing, you have to pay to open a leverage trade via either commission or spread. When you pay via the spread, the cost of your trade are incorporated into the bid and ask prices. Commission, they are separate. You will also pay borrowing costs on positions that you keep open for more than a single day. This is called overnight financing. Financing is when you pay overnight financing is essentially an interest payment to cover the cost of your leverage. At Forex.com, we charge 2.5% above or below SONIA, over an equivalent interest rate, depending on whether you have a long or short position open. On positions with no expiry, overnight financing will be charged each day that your trade is open. With forwards, the cost of financing is already incorporated into spread, so you don't have to pay each day. Calculating overnight financing. To calculate overnight financing on a long position, you take its size at the end of the day and multiply it by SONIA plus 2.5%. Then you divide that figure by 365 to get daily rate. Did you know you don't have to calculate financing charge manually whenever you trade? On Forex.com platform, you can see the overnight financing charge for any market by looking at the Market 360 tab. You buy 1,000 CFDs on company ABC at 435 cents. And your target price is 480 cents. You buy price, end of day price. Overnight financing is calculated as will be debited from your account. Say you own 1,000 CFDs at 450p at the end of trading day, and SONIA is 3%. Your position is worth that. SONIA plus 2.5% is 5.5%. 5.5% of 4 is £247.50p, 68p. When shorting, meanwhile, the calculation is the same, except that you minus 2.5% offside instead of adding it. Your account may be credited with the overnight financing fee depending on the interest rate. Your position is worth that. Sonia minus that 0.5, 202.5, 6p. If you want to trade $100,000 worth of AUD USD, which requires you to pay 5% as margin, how much margin do you need to put down? So that's 0.05 times 100,000. I can't do maths. 5,000. AUD USD moves up and you close your position, earning your 8,000 profit from your 5,000 margin. What is your return on investments? Earning from your 500,000 profit. So that should be 8,000 minus 5,000, which is 3,000. 3,000. Let's see. Calculator. So 8,000 minus 8,000 minus what's going on? 8,000 minus 5,000. You put in 500, so 5,000 times 100. Oh, that is not there. £8,000 profit from your £5,000 margin. What is your return on investment? So you made that. Oh, is it okay, I see. If you had fallen and you lost, what would your total return be? So how much did you put in again? 8,000 was it? Was it 5,000 that you put in? 5,000. No, that is not it. I lost you 4,000. What would your total return be? If that had fallen and lost you 4,000, what would your total return be? So you'll lose that. How much did you put down? 8,000 you put down, wasn't it? Or 4,000? 8,000. So it's 4,000 divided by 8,000 then. Huh? No. What? Now, how much did I put down in the first place? I forgot. Is it 8,000 or 4,000? Let's look at the history. $8,000 divided by 5,000. So I put in 5,000. 5,000. $1.25. What? Okay. What? Okay. Yeah, that's gonna need some more work. That is, wait, how far are we on? Oh, we still got some time. Right, okay, using orders to open positions. When trading, you'll open and close positions using orders. So, trading positions are open and closed using orders. What is an order? An order is an instruction to execute a trade. So, instruction to open or close a trade. To execute a trade. You use them to tell your broker or trading provider when you want to open or close positions. There are a few types of orders available, and learning how they all work is an important part of understanding the markets. Traditionally, investors gave orders to brokers over the phone, but the rise of web trading means most traders today raise orders using online platforms. If you've been using a demo to buy and sell so you learn with Trading Academy, then you've been placing orders. We're going to look at all the standard types of order you might use in day-to-day trading, starting with the simplest, market orders. So let's close that. Market orders. Most basic type of order, which tells your provider to execute at the best price available at the time. Tells the to execute at the best price at the time available. EUR/USD is at 1.0745/1.0746. Using a market order as an instruction to execute a trade as close to that level as possible. You can use market orders to open or close a position. In your Forex.com demo, you'll execute market orders using the Trade tab on your deal ticket. So that bit there. The current EUR/USD bid is that, and the risk and the ask is that buy at that, sell at bids. Entry orders. But what if you didn't want to trade at the current market price? You might, for example, think that buying EUR/USD is a great opportunity, but only if it drops to that 1.0699. You could watch euro/dollar and open a market order when it hits 1.0699, or you could use an entry order. Entry orders. Automatically open a position when the market hits a predetermined level set by you. This is particularly useful for traders looking to sell at a specific price and who don't want or don't have the time to monitor the markets constantly till this level is reached. There are 4 types of entry orders: buy stops, buy sell, sell stops, and sell limits. Four types of entry buy limits, oh no, buy stops, buy limits, sell stops, and so what is buy stops? Instruct your broker to open a long position. Open a long position on a market when it hits a specified price above its current price above. Buy limits. Open a long position when the market hits a specified price below its current price. Sell stops. I'm assuming that's going to be the opposite of buy stops. Open a short position on a market when it hits a specified price below the current one. Sell limits. Open a short position when the market hits a specified price above the current one. Buy, so long positions when it hits a price when it's above its current price. So only buy it when it's above the current price. This one is only buy it when it hits below a price. This one is sell it when it hits below a price, and sell it when it's above a price. Stops versus limits. You'll hear the term stop and limit used a lot when it comes to orders. Stop is an order that will execute at a level that is worse than the current price. Limit, an order that will execute at a level that is more favorable than the current price. Worse or more favorable doesn't have to mean below or above. However, take our buy and sell limit entries above. When you're going long, a more favorable level to open at is below the current price. You'll make more profit if you open there, but if you're going short, it's above the current price. Right, okay. Good till when, as well as deciding your trade position, direction, quantity and level, you can decide how long the entry order will remain active for before your provider cancels it. The three options you'll see on Forex.com platform are good till cancelled, good till end of day, and good till time. Decides how long an entry order will remain active for. before it gets cancelled. What? Oh, okay. Good till cancelled. Good till cancelled. Good till end of day. Good till time. Good till cancelled. If you choose good till cancelled, then your entry order will remain active until you cancel it manually. Will remain active until you cancel it manually. The market expires, or it is triggered. That could mean it's still active weeks or months after you first place it. Good till end of day. Meanwhile, will automatically cancel at the end of the trading day. Automatically cancel at the end of the trading day. This is useful if you think that your chosen opportunity won't last. Useful if your chosen offer won't last. With a GTD, there's no risk of you forgetting to cancel, ending up with an unwanted trade. Good till time. Good till time gives you maximum flexibility. Gives you maximum flexibility by enabling you to choose the precise time and date that you want your order to remain active until. By allowing you to choose the exact time and date that you want your order to remain until. If the market hits your chosen level in that means time frame, your order will trigger. If it doesn't, your order will cancel. You want to remain active if it hits your chosen level in that mean time frame. Place an entry order in Forex.com demo. When trading Forex.com, there's no need to select between types of entry order. To open a practice position, simply log into your demo, choose a market and open its trade ticket. Select the order from the top bar, choose whether to buy or sell, and enter your order price, which dictates the level which your trade will open. Choose your quantity and decide when the order should cancel. Hit place order. The UK 100 is at 1,015,000 and you place an order to open a long position at that. Is to say, this is and you place a long position. This is a buy. It's either buy limit or buy stop. I think it's once above and once below. I'm pretty sure it's a buy limit. No, it's a buy stop, isn't it? Yep. Okay, so stop is above. Barclays shares at 232.3 and you want to use an order to short them when it hits 241. This is a sell and sell limit. Boom. Okay, take profits and stop losses. I think we're gonna leave this video here. Thank you very much for watching. I'll see you guys in the next video on take profits and stop losses. Peace out.